And good morning once again, options traders. Well, in this video, we're going to talk about another technical indicator, which we do from time to time. And this time we're talking about something that is more about volume than it is about your candlesticks. And it's called relative volume. And it's critically important for all of you who follow volume. I'm not really a big volume guy. I do look at it, but some people really put a lot of emphasis on the volume. And for those who do, you really should understand relative volume. Now, unfortunately, a lot of platforms don't offer this, but for those who do, you'll definitely want to use relative volume. So what is it and why is it so important? Well, let's go have a look. And as always, before we get started, please click like and subscribe. It goes a long way into promoting the channel and is always appreciated. So let's start with relative volume. What it does is it's actually a fairly simple calculation. It just compares today's volume to an average over what's called a look-back period. This is what the technicians call in the technical world when you go back, let's say 30 days or 50 days to calculate, let's say, an average. That's called the look-back period. So we might use, let's say, the average of the past 50 days. And let's say that we get an average of 100. Of course, that would be really low volume, but let's say it could be 100,000, it could be 1,000,000. It's just, we'll call it 100 units. And so that's the average over the past 50 days. And today's volume, let's say, is 170. Well, relative volume would just say, let's take the 170 bar from today divided by the average. So 170 divided by 100 would be 1.7. Relative volume would be 1.7, and that just means that today's volume is 1.7 times higher than it has been over the past 50 days on average. Now, of course, we can do all kinds of tweaks. Some platforms will allow you to use an SMA, simple moving average, or an EMA, exponential moving average. So there's all kinds of variations that you might see, but the idea is always the same. You're just taking the current volume bar and dividing it by the average over some look-back period. So for example, let's say that these are the volumes over the past few days, and just to make the average simple, I'm going to keep them all at 100 for the first 5 days. We're going to use a 5-day look-back period, and again, that's just done to make the example easy to do and to construct. So the way we would do it is to look at the first 5 days. What's the average here? The average is obviously 100. And so the relative volume for today's volume is 110. We're going to take 110 divided by this average. So relative volume would be 110 divided by 100, or 1.1. Now, the next day, when we get this volume of 120, what's its RV? Well, we need to look back 5 days. So we're going to go back these 5. Notice that we've picked up 110, and we've dropped off the first 100 over here. So the average has increased, but so has today's volume. So the average over these 5 days is now 102. We're going to take 120 divided by 102, and that gives us 1.18. So today's relative volume would be 1.18. And again, that just means that today's volume bar is 1.18 times bigger, or 18% bigger, than the average over the past 5 days. So now that you know how it's constructed and interpreted, how do we read it? Well, obviously a value of 1.0 means that it's average. So if today's relative value is 1.0, it just means that today's volume bar is exactly the average of the look-back period. That's why it's coming out to be 1.0. If it's greater than 1.0, then today's volume bar is something above average. And if today's RV, or relative volume, is below 1, then it's below average. Now, there is no theoretical maximum, but values above 4 are considered to be abnormal spikes. So if you get something like 1.1 or 1.2, is that necessarily going to cause you to take action? Probably not. But if it's above 4, that would definitely be something that would really be an outlier. That would be an abnormal type of spike. For the most part, trading thresholds will vary, but a common level is 2.0. So if you see that today's volume is twice the average of your look-back period, that's where a lot of traders will start to take notice and say, yes, today's volume is exceptionally large. Now, what are some variations with relative volume? Well, some platforms will convert it to percentages. So again, if you see that today's relative volume is 1.1, some platforms might just show that as 10%, meaning that it's 10% above average. Now, others will add standard deviations, and to me, this is really important because standard deviations give you absolute comparisons. For some stocks, a 10% increase might be pretty big if it doesn't really have a lot of variation in the volume, whereas other stocks, 10% might be absolutely nothing. So this is why you'd have to be careful about comparing stock A that has a relative volume of 1.1 to stock B with a relative volume of 1.1. It doesn't really mean that they have the same significance in terms of those volume bars, but a standard deviation does. The standard deviation takes into account all of the variations. That's why it was created. It is a way to make apples to apples comparisons. So if your platform allows you to put standard deviations on there, that's really the one that I would use. So as I mentioned before, E-Trade doesn't have relative volume on it, but ThinkorSwim does. So for those of you who use ThinkorSwim, let me show you how to put it on your platform and some of the nice little changes that you can make to your relative volume. All right, so now we're into the ThinkorSwim platform. I'm going to use Apple. Here are the candles, and down below is the volume. This is just a standard volume. And so what ThinkorSwim allows you to do is to make the bar green if it's a green candle on that day, or to make the bar red if it's a red candle. So the thing is that you don't really have a good handle on which of these spikes up here are really significant. Like on this day right here, this green bar is fairly big compared to these, but how big? Is it really all that much bigger? Is it a significant spike? What about this decrease? Is it really a big drop off or not? And see, a lot of times you can be led down a bad path of decisions and saying, oh, the volume is dropping. Well, is it really dropping that much? Or is it still well above average? And that's really the better way to look at it. So if you wanted to put relative volume on your ThinkorSwim charts, here's how you do it. Come up here to Studies, left mouse click, and one of the easiest ways is to go to Edit Studies, and just over here type in relative. So if you type relative, right there you should see relative volume standard deviation. This is your relative volume, and it also allows you to put the standard deviation on. Left mouse click there, choose Add Selected. It's going to bring it over here to the right. Notice it's a lower study, just like your volume down here, or other technicals such as RSI or MACD. It just means that it sits off of your chart. It's not an overlay. So choose Apply, and there it is. Now I'm going to lift this up so you can see it better. So this is the standard layout. Now what you're looking at is all of these bars are positive. They are all above average. But only some of these bars have broken the 2 standard deviation mark over here. And so those get a different color. One thing that I don't like that TOS did is it makes the standard default this pink and like a light peach color. It's really hard to differentiate them. So let's go change that. Let's come back up here to Studies, go to Edit Studies, click on this cogwheel, and down here on the left there are the bars that are above 2 standard deviations. Let's make those green. I'll go ahead and leave these in a kind of pinkish color, but you can certainly change that. Now up here is the look back period. We're going back 60 days, and we can also change the number of standard deviations. The default is 2, and that's probably where I would leave it. But if you wanted to change it, you certainly could. So let's choose OK, Apply, and OK. See, now it's much easier to see. So once again, all of these bars, whether this pink or green color, are all above average. So on one hand, you can think that they're all green. They are all above average. However, in order to become a green bar, it has to eclipse this 2 standard deviation mark right there. That's what makes them green. So you could say that the ones that are really significant are when we start going above 2 standard deviations. If you wanted to change that and make it 1.8 standard deviations, you certainly could. However, what if we have below average days? Now, most of the time, people who follow volume are only interested in big spikes follow usually big down days, but they can also be for big up days. But it's usually the fact that we're looking for big volume, not low volume. In the world of technical analysis, it's usually said that volume precedes price. Before you get a big up move or a big down move, we usually have big spikes in volume. But for some reason, if you wanted to see abnormally low days, we would need to see negative bars. All right, so remember, all of these bars are above average, whether they're pink or green. So if we wanted to see days that they were below average, we need to come up here to Studies, go back to Edit Studies, click on your cogwheel, and then right here in this drop-down menu where it says Allow Negative Values, you'll want to make that Yes. Choose OK, Apply, and OK. See, now we can see where we have below normal volumes. We've got some that are 1 standard deviation down, actually a little bit more. So again, if you wanted to, for some reason, see the low volume days, that's how you could do it. Now, again, watch what happens when I flip it back to no. All of these negative values in here, you're just going to see blank spaces. So let's come back up here to Studies, Edit Studies, Cogwheel, change that to no, and watch all of these bars disappear. See, now you've just got these big gaps. And so anywhere in here where you had these gaps, it's because you had below average volume. But once again, most traders aren't worried about days for below average volume. So I would probably just keep it here. Show only the above average days, and the ones that you really want to pay attention to are the green bars whenever we spike above 2 standard deviations. So that's a really handy way to get a handle on if the volume from today is truly large. Don't look at it bar to bar. That tells you very little. You want to know if today's bar is bigger than some average. Then the next question is, how much bigger? And both of those are answered by relative volume and standard deviations. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.